welcome to Taking Stock, the show where we take stock of the week gone by and prepare you, of course, what's coming up next week. I'm Surabhi Upadhyay, and with me is Anuj Singhal. Hi, Anuj. I guess been a very, very interesting week for the market, right? When we started off, it was looking like gloom and doom. Then towards the end of the week, we got some, some great bazooka shots, so to speak, which powered the bulls back up. What do you think of it?
Yeah, so you could divide the week in two halves, Surabhi, Monday to Wednesday, and of course Thursday and Friday. Till Wednesday, we continued to make that process of lower low and lower high. I think on Thursday, we firmly broke that. And on Friday as well, though it came off the high point, keep in mind it was weekend as well. A lot of people would have wanted to book some profit. So for me, the big takeaway this week was that Nifty respected its 50-day moving average, is now a 20-day moving average, so could go either way. That's important mark to watch out for. The Moody's move is now priced in, Surabhi. All eyes now on global cues. And I think you will see that from Monday, we'll forget about Moody's move and we'll just focus on crude oil and the Dow and all of that, once again, would be important point to watch out for. The other thing which happened this week is, though it didn't need reaffirmation, is that the Bank Nifty is firmly the leader of this market. That made a new all-time high. So clearly, and I've seen this in the past, when the Bank Nifty is the first to make all-time high, Nifty normally follows suit. So let's see if we have that. For me, I think the key takeaway was that it respected the 50-day moving average.
Okay, absolutely. Well, we will be discussing a lot of those triggers as we go along. Joining us on the show to talk about all of these cues is Nilesh Shah, Managing Director at Kotak Mahindra Asset Management Company. Nilesh, always a pleasure talking to you. Thank you for joining in. So very interesting. The first half of the week gave plenty of ammunition to the bears, and you could start building a case about higher oil prices, rising bond yields, etc. But the second half saw, a bit of the positivity coming back. How do you sum things up and where we stand today?
So clearly, from a flow point of view, Moody's upgrade provides a great opportunity to India. There are many pension funds who don't invest in India because of our lower rating. Now they have opportunity to consider investment in India because of this rating upgrade. Obviously, their flows won't materialize tomorrow itself, but over a period of time, we can see increased participation from pension fund investors who have so far avoided India because of its lower rating. The second thing is participation in the debt market, both offshore as well as local. Again, as the rating upgrade happens, your credit limit on a country as well as its company starts going up. The spread starts reducing. So one side you have the benefit of cost and also the benefit of volume. One could see increased allocation to Indian debt in offshore as well as local market. Local market obviously will subject to the debt limits, but you have SDL limits which is open. Put these two things together, it gives a lot of confidence to investors. And this rating has come to India almost after a gap of 13 years. So clearly very positive from a flow point of view to the equity as well as to the debt market.
Okay, Nilesh, always good talking to you. So, this is a question that I've asked a lot of people today. If global picture also stabilizes a bit, do you see a bit of a melt up for our market over the next couple of months or next 3 months if everything falls in place?
Anuj, we have started hearing this term melt up suddenly. And all the ingredients which are necessary for melt up are definitely present in market. There is liquidity chasing stock. There is expectation of enhanced flows from the foreigners. People are also not seeing commensurate return in alternative asset classes like fixed income and gold. But my hope will be that this opportunity be encashed by government for divestment and creating supply. This is the best time to provide supply to the market so we don't end up into a melt up kind of situation, because whenever we go into that kind of situation, it will attract hot money, it will attract uninformed investors, it will attract dumb money, and later on they'll have to pay the price. It's far better for investor confidence that we gradually go up rather than melt up.
Fair enough. But what about the concerns, Nilesh? The price of oil, which continues to be in that range of 62, 64. and the fact that the bond markets are sort of giving us a nervous sign with yields continuing to be fairly high at 7%. Is that a concern for equity investors?
So undoubtedly on oil prices, we don't have much control. However, broadly the consensus is that this jump in oil is attributable more to the geopolitical events, especially what's happening in Saudi Arabia. It is less reflection of demand-supply mismatch. So we have to hope and pray that oil prices will remain between $40 to $60 and they wouldn't remain elevated for a long period of time. A spike of a month or two due to geopolitical event can be absorbed by the market, but if expectation remains of an elevated oil prices, then to that extent we have to make correction in our fiscal stance as well as in our current account deficit. Clearly Moody's have not bothered about what's happening to oil prices and what stress it can cause to India's fiscal deficit in reaffirming this rating upgrade. The second thing is on interest rate side. Now clearly there is a transition where RBI earlier used to manage growth, inflation, money supply, banking system stability, currency and government's borrowing program. Today they are mandated to manage inflation around 4% plus or minus 2% level. Now, if RBI manages inflation at 4% level over a period of time, that will definitely reduce inflationary expectation. And then if we see the real interest rate, which is available on a 10-year government securities, which is running at about 7%, clearly 3% is too high a real interest rate. I was this week in Thailand marketing our equity fund over there, and I saw bank fixed deposits being offered at 2% interest rates. Thai deposits are lower than 10-year US Treasury. So clearly, if an emerging economy like Thailand could have a lower cost of capital, lower deposits, lower real rate of return, there's no reason to believe that over a period of time, not necessarily tomorrow or day after tomorrow, but over a period of time, as RBI anchors inflationary expectation around 4% mandated level, the real interest rate has to come down, the nominal interest rate has to come down. So on interest rate market will take comfort that interest rates eventually will come down. However, market, as Anuj mentioned, will have to start looking at oil prices far more carefully if they remain elevated.
Nilesh, what about politics? Your home state goes to election and will have, of course, outcome in a month. There's been some murmur of whether, if the ruling party does not win with, same majority like they did or like they have been doing for last 3 terms, in that case, there could be some nerves for the market. Do you agree with that view?
Undoubtedly, today market has priced in continuity of economic policy and more importantly with rating upgrade, a kind of second generation reforms to be unleashed. It's not that we have reached Paneka of credit rating. It's not that we have reached, peak of economic growth cycle. We have to unleash second generation reforms in labor, in ease of doing business, in faster and speedier infrastructure development. So clearly market is pricing in continuity of economic policies and extended economic reforms. Now, if an election result kind of gives an outcome which is different or contrary to this expectation, then certainly market will have to make an adjustment. So people will be watching Gujarat and Himachal Pradesh election results. Himachal outcome will have limited impact on market, but Gujarat outcome, being home state of Prime Minister, will definitely have material impact on market.
Finally, Nilesh, in some ways, I think the sector of the week was real estate because of the news that we got on Thursday with the scope of this subsidy on affordable housing being extended. Do you like real estate plays that are available right now? If not real estate, then housing finance companies at current prices and valuations, are they still a buy for you?
So it's a very, very interesting question. We do like real estate as a sector, especially with government unleashing reforms in that sector from demand as well as supply side. On demand side, they are extending interest rate subvention schemes. They are allowing EPF for premature withdrawal for buying of a house. So this is creating robust demand. On supply side, they have enhanced affordable housing limits. They are giving speedier approvals in certain parts of India. The problem for us is to find out right vehicle. In real estate, some vehicles are over leveraged. Some companies are having questionable governance track record. So in the listed real estate space, there are very limited opportunities. We think it is far better to play this coming real estate boom via ancillary sectors rather than pure real estate sector. And as you mentioned, housing finance company, apart from that you have cement, building materials, cables, wires, paints, all those kind of ancillary sectors where we believe growth could be higher than what is expected by the market, and hence it might be equally rewarding like a real estate company.
Okay, Nilesh, always good talking to you. Have a good weekend. And of course, we'll touch base with you next week. Let's do one thing. We'll take a break. Once we come back, Ashwini Gujral will join us for the market technicals.